Hello and welcome to Your Money, Your Mission, the show that helps you maximize your wealth by turning complex financial situations into actionable advice, powered by Johnson Financial Group. We get asked a lot about how to generate a good return in the safest way possible, especially in today's market. So on this episode, we have 3 different callers, all with questions about making a good return safely in volatile times. My guests today are Eric Bernal, Senior Vice President and Portfolio Manager, and Luke Kasten, Vice President and Private Banking Regional Manager. Both are with Johnson Financial Group. Welcome, Eric and Luke.
Thanks for having us.
Great. So with interest rates on the rise today, our topic is cash strategies, and we know that this can be part of a robust financial plan. So we're going to take a question from Richard. Richard?
Hi, Kelly. My family is very fortunate to have a terrific family business that was built by my father and grandfather. We've always strictly managed our cash flow. For years, there was no decent return on short-term cash. As rates have increased, I'm hoping there are some strategies that will keep the money safe but take advantage of higher rates. We usually have a decent surplus of about 5 or 10 million around the end of the year and don't really need to start accessing that money till about June. Any suggestions?
Eric, you've come across this type of thing before, haven't you?
I have. In the last 2 years, it's been a common theme in what we're seeing from businesses and organizations, seeing more cash on the balance sheets these days. So yes, it is a good problem to have, but a better environment to get better yields on some of your safer dollars. With that being said, options are definitely opening up. 2 years ago, it was very difficult to get any type of yield on safe investments, whether it be checking, savings, CDs. Now what we've been doing is trying to get more creative and trying to optimize the yield for clients. What we've been doing is structuring some type of fixed income cash management solution. Many of these businesses have been, their main objective has been to preserve capital. And with that being said, we want to invest in securities that are going to have a high quality remark, as well as making sure their principal is being returned. So we've been utilizing CDs as well as treasuries, and understanding their cash flow objectives and when they're going to need dollars for projects. So what we've been doing is structuring these CDs and treasuries where they come due and making sure they're in line with their cash flow needs, giving them the opportunity to not only preserve capital, but also optimize the return along the way.
Thanks, Eric. This next caller has a question, I think, for you, Luke. Tara?
Hi, Kelly. I lived through 2008, and thank goodness I still had a long runway of work left so my 401k could recover. I've weathered the pandemic, the recent inflation, and market volatility, but now I'm getting closer to retirement, and I'm thinking about safer strategies, specifically for some significant bonus dollars that I used to pour back into the market. I'd like a safe and more short-term option, but I don't want to necessarily sit on the sidelines in terms of growth. What options could you recommend to me?
Luke, what would you say to Tara?
Yeah, it's a very good question and a topic we've discussed a lot here recently over the course of this first part of the year. To understand the time frame is really important, and to have a cash strategy in place is really critical. We did come out of a period of time where we had 2-3 years where cash really wasn't offering much of a return, and so the opportunity risk, right, to not leverage other resources to invest those funds, right, was significant. And now that we're in a period where interest rates have returned a little bit, it creates that conversation around your time frame and kind of what your goals and plan and place in life are, right? And as you're heading into retirement, having a more conservative structure around your cash. CDs have become very popular here. We talk a lot about, what is the next 3, 6, 12 months look like for you? And then understanding what maybe needs to be kept in cash on the sidelines, right, in a liquid money market, which is still, earning a significant return these days in that 4 to 5% range. But also then looking at, 6 months, 12 months, right, considering a CD ladder strategy of, structuring that out over that time period to earn different different rates over different terms, but also having it come due at different periods to give you that flexibility and coverage there over the course of that period. And then anything above 12 months, it's really the importance of that combination of having that relationship with your banking partner and your financial investment partner and your planner to kind of have that strategy in place around partnering and understanding the plan. The plan kind of drives what we do here. And understanding that there are opportunities to maybe for longer term assets, right? Partner with our investment team to put those strategies in place.
And the plan actually captures all those client goals, the short term and the long term. Is that right?
Absolutely. It's kind of a goals based plan, right? So the plan, the goals drive our strategies and what we bring to the table for our clients.
Great, thank you, Luke. Let's now hear from Kimberly.
Hi, Kelly. My husband and I were lucky during the pandemic. Our business continued to thrive, and now we have some additional cash. But we want to make sure we're prepared in case of a future emergency. We need an option that is conservative but earns a decent return. We're thinking about a line of credit in the event of an immediate need, but want a suggestion for what kind of options we should consider.
So this is probably something both of you have dealt with for clients. So how would someone go about evaluating that?
Yeah, the line of credit is something we talk about with our clients pretty much in every conversation, right, that we're having about, what their goals and how we help them best leverage their assets. And for everyone it looks different, right? I can count a number of times where I've had the conversation with a client about, I need a line of credit. Well, when did you need it, right? I needed it yesterday. Well, now we're in that rush to put it in place, but to have that there kind of gives you that peace of mind to know that as things come up, you are prepared and you are in a good position to leverage that line of credit to, make that purchase or investment or whatever you may be looking to do. And for everyone that looks a little different. For some people, it may be leveraging the equity in your home, right, for a home equity line of credit. Another attractive option, that's kind of come up is leveraging your investment portfolio, where your assets still stay and continue to work and grow for you, but you can leverage that, on a line of credit as well. And for business owners, it goes across the gamut to, making sure you got that line of credit in place for anything your business may come up as major expenses, over the course of, the year as well. So, there's a lot of great attractive options for how to structure a line of credit, and we'll go through that, conversation with our clients and talk through what makes the most sense for them.
Great. And Eric, when you're thinking of a line of credit, and thinking about the investments, what are you really evaluating?
Well, first of all, let me say it's very important to address the immediate need, right? Whether it be a line of credit, making sure there's an emergency account in place. But I think we need to step back for a moment because, at Johnson Financial Group, what we like to do is we like to make sure that we're, getting the smartest room in front of the client and having a different level of expertise to handle different aspects of the financial picture. Not only that, but you also want to make sure you do have a solid financial plan in place because that's going to provide you with a roadmap. And the reason why I'm going down this road at the moment is because a home equity line of credit will be basically a tool within that financial plan. What I talk to clients about is segmenting their financial picture. Again, taking a look at your assets, whether it be short-term, intermediate, or long-term, and then making sure that each bucket is being addressed at the appropriate time. So, for example, your emergency account should be addressed first and foremost, whether it be with a line of credit or whether it be, 3 to 6 months worth of cash sitting on the sidelines, because if something does arise, the last thing you want to have to do is start pulling dollars from, let's say, a retirement account where you're getting penalized for pulling dollars out. So I think you need to segment your dollars first and foremost. Make sure that you have the smartest room in front of you, and then also start segmenting your financial picture. Once you can kind of tackle those things in a row in the way that they should be tackled, then I think that you'll start to see all of these different tools and all these different types of investment vehicles start to fall into place. Because again, at the end of the day, you want to make sure that they all are complementing one another.
So it's the financial plan that's really going to drive what tool you use to meet that need.
Correct.
And it's interesting because you've mentioned a couple of times now that you work together to kind of bring that smartest room together. And I know that becomes logistically easy at Johnson Financial Group because we have this umbrella of services. But that's what you would recommend even for clients outside of Johnson Financial Group. Isn't that right? That you would think that combination of expertise makes sense?
Absolutely. It's kind of that left hand knows what the right hand is doing, right? We don't want to be doing something on one hand that's counteracting maybe the goal or what's been put in place on the other side. So whether it's here within JFG or if your advisor and banking partners are not within the same institution, still having them connected is critical.
100%. I mean, I've been in the business for a little more than 23 years, and I say that's what sets Johnson apart is having a team of experts. Don't get me wrong. Again, I think that we've been all doing this long enough where we may know a little bit about something else that maybe is not in our lane, so to speak. But I'm not an estate attorney. I'm not an accountant. I'm not a banker. I mean, I manage portfolios, and that's what I do. I feel I do best. So if I need to bring someone in that handles the other side of the balance sheet, where that's all they do every single day, I feel more comfortable with getting advice and guidance from that type of individual.
Yeah, that makes a lot of sense. Thank you. So for years, you both mentioned that the rates were low, and so there wasn't a lot of excitement around cash strategies. So I have a question for each of you, actually. So Luke, I'd really be interested in understanding more about the power of cash, especially in uncertain times, and how you evaluate what the right amount is for the particular client. And Eric, I know I get a lot of questions about opportunity costs. And when we're thinking about cash strategies, people are interested in knowing what that trade-off is. So actually, we'll throw it to you first, Luke.
Yeah.
What do you?
No, as far as the power of cash, right? I mean, it's driven by what's going on in the economy, the environment, and that's something that we're constantly paying attention to, and as a part of our conversations with our clients to review and understand, there's a shift that's going to take place, right? What we had over the last 2 to 3 years and where we sit now, it's going to be a different type of conversation and a different strategy. So, how we handle cash, right? When rates aren't paying very much, right? Then there's, less opportunity risk involved with that, right? And so now we're in a position where, more opportunity risk at that time because your cash really isn't doing anything for you sitting on the sidelines. So now we're in a position where, cash rates are a little bit higher, right? We can earn something, decent on our money markets and CDs and have that in place. That gives you that flexibility to know that you've got options and you can kind of take the time and have the conversation. But I think for us, that partnership with our financial advisors and our planning team is what sets us apart, right? I mean, that's the key component of what we do. It's that goals-based plan, right, that drives our strategy and our conversation and things that we're doing for our clients. So that is, that's our bread and butter.
Yeah, so definitely portfolio optimization is something that we talk about in our committee meetings and whatnot. So also you compound that with making sure that the time frames that you have are working for you versus against you. When you think about where we're currently at in this environment right now, we're dealing with an inverted yield curve, and we've been dealing with an inverted yield curve for some time. And what that just really means is that, we're getting paid more on the short-term type of vehicles like, 2-year CDs or less versus going out and buying a 10-year piece of paper. So what you can do is not only take a look at, when you may need dollars or what you're utilizing those dollars for, but also what type of environment we're in. How long should you be investing in your short-term or your conservative investments? Should I be buying those 1-year and 2-year piece of paper just because I can get north of 5% versus, again, a 10-year piece of paper that, might be providing a lower interest rate at the moment. So I think that you have to consider all of these different factors. And, if you're not able to research or kind of take a look at what the environment is giving you at the moment, just make sure that you are putting the smartest room together for yourself, whether that be at Johnson or outside of Johnson. But I think that's very important because you want to make sure that you're utilizing all your resources to make sure your money is working the best for you at that moment.
Great. Thank you both for being here. We really appreciate your time and your advice. And thank you for tuning in. If you have questions, make sure that you go to our show notes, click on the link, write your question, and hit submit. We would love to hear from you. And make sure you subscribe so you don't miss any future episodes of Your Money, Your Mission, the podcast designed to maximize your wealth by turning complex financial issues into actionable advice. Powered by Johnson Financial Group.
Products and services offered by these Johnson Financial Group companies, Johnson Bank and Johnson Wealth, Inc. Johnson Bank is member FDIC, equal housing lender. Wealth management services are provided through Johnson Bank and Johnson Wealth, Inc., Johnson Financial Group companies. Additional information about Johnson Wealth, Inc., a registered investment advisor, and its investment advisor representatives is available at advisorinfo.sec.gov. Not FDIC insured, no bank guarantee, may lose value.